A tide of dollars, how global liquidity is reshaping India's economic landscape. Global liquidity is a term that has become ubiquitous among financial professionals, economists, and policymakers. But what does it actually mean and why should we care? Simply put, global liquidity refers to the ease with which assets can be bought or sold without causing significant price changes. It's the oil that keeps the gears of the global financial system turning smoothly. In the context of international finance, global liquidity can be understood as the availability of funds for investment and spending across borders. These funds can flow from a variety of sources including central banks, commercial banks, and other financial institutions. The level of global liquidity can have significant impacts on economic growth, financial stability, and the balance of power among nations. The flow of global liquidity and its effects. When global liquidity is abundant, money flows freely across borders, fueling investment and consumption. During these periods, businesses can easily obtain financing to invest in new ventures or expand existing ones, while consumers have access to credit for big-ticket purchases like homes and cars. Emerging markets, including India, often benefit from these conditions as international investors seek higher returns. However, there's a flip side. When global liquidity tightens, it can precipitate a rapid reversal of capital flows, leading to financial instability. This is especially true for economies like India that have come to rely on these flows to finance growth. In the aftermath of the 2008 global financial crisis, central banks in developed economies implemented unprecedented monetary easing policies to boost their economies. This led to a surge in global liquidity as investors looked for higher-yielding opportunities outside their home markets. Countries like India attracted substantial capital inflows during this period, which contributed to robust economic growth. Case study: India and the taper tantrum. A prime example of the potential pitfalls of relying on global liquidity can be seen in the taper tantrum of 2013. As the US Federal Reserve announced its plans to gradually end its quantitative easing program, global liquidity conditions began to tighten. This led to a sudden outflow of capital from emerging markets like India, causing currency depreciation, stock market falls, and overall economic instability. Current trends in global liquidity. In the wake of the COVID-19 pandemic, central banks once again resorted to monetary easing to support their economies. This has led to another surge in global liquidity, with money flowing into assets around the world. For India, this has resulted in a significant influx of foreign capital, especially into its stock markets. This inflow has supported a strong recovery in the Indian economy, which was hard hit by the pandemic. However, it also presents potential risks as the economy becomes more exposed to changes in global liquidity conditions. The road ahead for India. India must tread a careful path. On one hand, the influx of global liquidity can help drive economic recovery and growth. On the other, it increases the risk of financial instability should these flows reverse suddenly. The Indian authorities have made some strides in managing these risks. The Reserve Bank of India, RBI, has been accumulating foreign exchange reserves as a buffer against potential outflows. Meanwhile, efforts are being made to deepen domestic financial markets and reduce reliance on foreign capital. However, the ultimate solution lies in global coordination among central banks and other financial institutions. This is easier said than done, given the complex and interconnected nature of the global financial system. Yet, the consequences of inaction could be dire. As the ebb and flow of global liquidity continues to shape the world economy, countries like India find themselves at the mercy of these tidal waves. Understanding and managing global liquidity is no longer an optional exercise. For nations like India, it is a necessity, dictating their financial stability and economic prosperity. In conclusion, the dance with global liquidity is a delicate one. It requires agility, foresight, and a deep understanding of the complex dynamics at play. For India, the challenge lies in harnessing the potential benefits of global liquidity while minimizing its inherent risks. In this financial ballet, every misstep can have far-reaching consequences. The tale of global liquidity and its impact on India is a testament to the interconnectedness of our world. It's a story that encompasses the gamut of economic phenomena, from the dry details of central bank policy to the high-stakes drama of financial crises. And it's a story that will continue to unfold in the years to come, shaping the fortunes of nations and the lives of billions of people. Whether we are financial professionals, policymakers, or simply engaged citizens, understanding global liquidity is crucial. Only then can we navigate the tides of the global economy, seize the opportunities they present, and weather the storms they may bring.